Welcome back to the channel. In today's video, we're diving into capital gains tax and why it's back in the spotlight. There's been talk from labor about raising it, and the reason behind that is pretty straightforward. They're looking for ways to bring in more revenue. Government spending is already extremely high, taxes are heavy, and now they're exploring different ways to balance things out. One of the key ideas being discussed is lowering income tax and possibly even removing national insurance. But to make that work financially, they'd need to replace that lost revenue somehow, and increasing capital gains tax is one option they're considering. In this video, I'll break down what's being proposed and also look at what happened the last time something similar was discussed. Before we get into the details, if you're new here, make sure you subscribe and turn on notifications. Join the growing community staying updated with property news, house price trends, interest rate changes, and property investment insights. And if you find this video useful, hit the like button. It really helps the channel grow and reach more people. Now let's get into it. At the moment, tax levels are already very high. In fact, you could argue we're paying more tax now than even in the years following World War II, which is quite surprising when you think about it. History has shown across different countries that when taxes get too high, economic growth tends to slow down. And if you look at the current data, GDP growth has been pretty poor for quite some time. It feels like the economy has been stuck without real momentum. Looking back, when Labor were last in power, VAT was around 17.5%. It was then reduced to 15%, which actually helped stimulate some economic activity, or at least soften the downturn. But after that, it was raised again to 20%, where it still sits today. Add income tax and other taxes into the mix, and it becomes clear just how much people are paying overall. Now, Labor are reviewing a new policy paper, exploring ways to reduce income tax. But instead of cutting spending, they're looking at increasing capital gains tax to make up the difference. That's where things get interesting, especially for property investors. Capital gains tax doesn't only apply to property, of course. It also affects shares, businesses, and other investments. But for many people watching this, it's most relevant when selling a second property, like a buy-to-let. If this tax goes up, it could have a big impact on landlords. In fact, it might even discourage them from selling, effectively trapping some in the market. That might actually be part of the intention, keeping rental supply stable and avoiding further rent increases. But that's just speculation at this stage, as nothing official has been confirmed. From a broader perspective, higher capital gains tax can reduce incentives for people to invest or grow wealth through assets. It can make people think twice about taking risks or expanding, which isn't always great for economic activity. So what's the upside for the government? Well, reducing income tax would likely be very popular. Not everyone pays capital gains tax. Many people don't have additional properties or investments. So lowering income tax would benefit a much larger portion of the population. On top of that, there's talk of potentially removing national insurance. Since that's a deduction most workers see on their pay slips, getting rid of it would also be seen as a positive move. If people have more disposable income, they might spend more, which could help boost the economy. To fund these changes, the plan would be to rely more heavily on capital gains tax. In simple terms, shift the tax burden from income to assets. Now, this isn't the first time this idea has come up. Back in 2020, under the conservative government, there were similar discussions. At that time, the country was dealing with the pandemic, and the government was spending huge amounts to support businesses and individuals, things like bounce-back loans, support grants, and the furlough scheme. Because of that, they explored ways to increase revenue, and capital gains tax was one of the options. Although they didn't go ahead with it, just the discussion alone had a noticeable impact. Many landlords decided to sell their properties early, fearing higher taxes in the future. As a result, around 7 to 12% of rental properties disappeared from the market over the following years. That's a significant shift, and it shows how sensitive the market can be to policy changes, even when they're only proposed. This is why these discussions matter. Even before anything is confirmed, they can influence behavior. Personally, I think there's a different approach that could work better, making the system more efficient and reducing taxes overall. Lower taxes can encourage more activity, more jobs, and ultimately generate more revenue through growth rather than restriction. I know some of the content on this channel has been quite negative recently, and I've seen the comments about that. But the truth is, this is the current situation. These are the challenges in the market, and it's important to be aware so you can adapt accordingly. If capital gains tax does increase, it will affect a large number of people selling assets. But at the same time, millions more could benefit from lower income tax and potentially no national insurance. From a political standpoint, that could make this move quite likely. As always, my goal is to keep you informed about what's happening, especially when it comes to property. Let me know your thoughts in the comments. Do you think this is a good move or not? And one last thing, whether you're a tenant or a landlord, make sure you get a copy of the Renters' Rights Act information sheet. Thousands of people have already downloaded it. It's the official version, unchanged, and while you can find it on the government website, it's easier to access through the link below. If you're a landlord, you'll need to provide this to your tenants within the next few weeks, before the end of May. A lot of landlords I've spoken to weren't aware of this requirement, and missing it could lead to a fine of up to £7,000. So make sure you grab your copy, leave a comment, like the video, and subscribe for more updates.